The bailouts have begun. SVB has been making headlines all over the place. You know, they used to be a really important part of the startup ecosystem, providing funding to some of the most successful companies out there. But now that it's failed, people are starting to realize the risks of relying too much on venture capital and unsustainable growth. You know, Silicon Valley, they've always been known for high risk, high reward investments. Well, SVB's collapse is making people wonder if that model is really sustainable. A lot of this was really because of what happened with their mortgage-backed securities investments that they did. And I'll break down exactly what happened. There's more to it, okay? This, in fact, wasn't so safe. They believed that they were in sort of the safe investment, but it turned out to not be the case. And it shows you that you shouldn't, as a company, have just one thing backing you up. Oh, we're going to invest in just treasuries or just mortgage-backed securities. There has to be more to it. And you look at it saying that the industry as a whole, what happened here? There are going to be more regulations put in place on the tech industry. We know that. And of course, the financial industry as well. Both of these will likely face increased scrutiny, but not today, because where were the regulators when they needed to be here? I think it was pretty clear that they were out to lunch. So I'm going to talk about what has happened right now, in addition to the videos I did previously. I'm not going to cover that stuff. I've already talked about it, and I'm sure you've already read about it. So this will only be brand new information here. Let's begin. You came here for the truth, so let me unveil that for you. Right here, beginning with the Federal Reserve press release, Federal Reserve Board announces it will make available additional funding to eligible depository institutions to help assure banks they have the ability to meet the needs of all their depositors. The Federal Reserve says we are going to backstop this. We will not have an issue here. Everybody is going to be A-OK. Now, it's a little bit long. I just want to read you the first couple things here, just so you know exactly what's going on. You don't hear it summarized somewhere else. To support American businesses and households, the Federal Reserve Board on Sunday announced it would make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors. This action will bolster the capacity of the banking system to safeguard deposits and ensure the ongoing provision of money and credit to the economy. That's a mouthful. But let me tell you, it means that the Federal Reserve is there to backstop any and all of this. Let me show you what else they have to say. The Federal Reserve is prepared to address any liquidity pressures that may arise. They set up a new facility, as they did in 2020, as they've done many times before. This time around, it's called the Bank Term Funding Program, BTFP. We're going to be hearing that in the news a lot, so keep that in mind. BTFP, offering loans of up to 1 year in length to banks, savings associations. And by the way, people have been asking about this. Credit unions are part of this. So there's your answer right there. And other eligible depository institutions pledging U.S. Treasuries, agency debt, and mortgage-backed securities, as well as other qualifying assets as collateral. These assets will be valued at par. The BTFP will be an additional source of liquidity against high-quality securities, and I can't believe mortgage-backed security is being considered that, but anyway, and eliminating an institution's need to quickly sell those securities in times of stress. So what happened here? Imagine the bank SVB has all these mortgage-backed securities. They got them when the interest rate was something like 1.5% on those. So they're able to get a yield 1.5% at a time in which all these other securities are giving 0%. So they're making more on that money. So they have this, and it's something that it's a long-term investment. But the deposits that they had, that they took in, the whole bunch of deposits came in, if you remember the previous videos, that's all short-term stuff. So the short-term stuff, and they're investing in long-term stuff. And then suddenly something changes whereby they have to go and sell that all at a loss, and they encounter this problem, and it has a chain reaction. So you see what happens here. There's a mismatch between the short-term and the long-term. And they were trying to get yield in a time in which it was very difficult to get yield. Super low interest rates causing a problem when that flips, when that reverses. This is something I've been warning about for a long time. Watch that and you see it. Here we are today. So that's part of it, okay? Let's look here. This is the next bank that has failed. Regulators closed crypto-focused Signature Bank, citing systemic risk. And my understanding is that it is actually the third largest bank that has collapsed. So SVB, second largest. This is now the third. So we are encountering a very serious issue that isn't SVB. People are going to be pointing to it. You can put that in the comments. You can look at the other analysts out there saying, don't worry about it. It's SVB all taken care of. The Federal Reserve is bailing them out. Yeah, but you're not understanding that the problems underlying all of this, nothing's been resolved. The issue with SVB is likely going on with many, many other companies. Yeah, they might be smaller than SVB. That's possible. But it doesn't resolve the conditions that are underlying it. And so we'll move on. I want to show you something else. U.S. rushes to avert crisis with SVB Deposit Guarantee Bank Fund. Actions will fully protect all SVB depositors' money, U.S. says. Fed creates a program to lend against collateral pledged at par. So here we have it. The government stepping in. They're saving the day. They're going to make sure that everybody is whole. I want everybody to know that. I want to make it clear that we have this. I'm calling it a bailout. You can call it whatever you want. Bill Ackman says it's not a bailout. Doesn't matter. They're bailing them out in a sense. Everybody's going to be made whole, and they're going to take care of this. That doesn't actually fix the problem, and it shows the big concern about people and their money. I've been talking about not having money in the banks for many years, and people laughed at me. And the real truth of the matter is, you shouldn't have money at a bank. Why would you do that? I mean, think about how crazy this is. The bank, knowingly, you go to the bank, you deposit your money in a bank. They don't keep that money. They go and loan it out to somebody else so that they can make money from it. So why are you keeping money at a bank? It's the weirdest thing why people keep a lot of savings at the bank. Yeah, you get your paycheck from your business. That's coming in. You have to pay the bills. You got to go to the store, you got to buy stuff. But why would you even ever have a savings account unless it was to save for a period of time, a lump sum, to then go put it somewhere? You don't, in my opinion, you do not want to have a savings account for any long-term savings. I mean, that is just something that's wild as far as I'm concerned, the way I look at that. And we have to know what assets there are. I've got my 2 books. I've got the Pillars of Prosperity, if you're interested in that. I mean, there's so much, okay? But that's part of it. Then I wanted to show you some graphics. I love the graphics. You love the charts. You could see it right here, Silicon Valley Bank's meltdown visualized. Here's what the second largest bank failure in US history looks like in graphics, just to give a comparison. Obviously, the larger the circle, the bigger it is, and you see Washington Mutual Bank, as well as Silicon Valley Bank. Almost the same size, very big stuff. That's been happening recently. There was more there. If you want to check it out, links in the description. The sources. After Silicon Valley Bank fails, tech startups race to meet payroll. Even established companies such as Roku and Roblox have deposits stuck at SVB. Something I brought up in the previous video was that if SVB is like the middleman and they are there, taking from either side, well then, what's going to be the result of that is you're going to have this stuck action that's taking place, and that will be resolved, of course. But if companies are using businesses in this way, what happens in the future? What's going to happen in this coming week? Are we going to encounter that with other companies where they start getting locked out? This is very dangerous because people start getting scared. They start getting wild and things happen. People overreact. That's what's going on here at this time. Startup founders are reeling as the Silicon Valley Bank funds are in limbo. Our heads are spinning. That's part of the same thing, okay? Where were the regulators as SVB crashed? Silicon Valley Bank grew too fast using borrowed money, and the risks were lurking in plain sight. And that's part of what I was talking about earlier. You see, this is an issue because they were, as they say, it grew too fast using borrowed short-term money from depositors who could ask to be repaid at any time, and it invested in long-term assets that it was unable or unwilling to sell. And so, coming back to the beginning, the takeaway here is the Federal Reserve is setting up this ridiculous facility in order to backstop it. But the way it works is, if an institution needs to sell, they don't have to do that. The Federal Reserve is going to be able to directly go with them and say, okay, we got you here. You've got your mortgage-backed securities. You don't need to sell them. We're going to act as kind of like a crutch to you for the time being, 1 year. Now, my understanding is like they've provisioned only $25 billion worth, which is like nothing, basically. If an actual bank failure occurs and all that, I think that might expand. We'll see what happens, okay? So that's the important part about this. That's what's occurring right now. The Federal Reserve setting up this facility and how that actually relates to the companies themselves. So that's the details, okay? When interest rates rose too quickly, it was saddled with the losses that ultimately forced it to try to raise fresh capital, spooking depositors who yanked their funds in 2 days. The question following the bank's takeover, how could regulators have allowed it to grow so quickly and take on so much interest rate risk? The funny thing was, what they were doing was considered low risk. You see? Mortgage-backed securities. Hey, AAA rating. Hey, it's all low risk. But we've been here before. And what they deem to be low risk is anything but. The second largest bank failure in US history, and the way that they did it was using low risk investments. Does that sound normal to you? Well, depends on who you are exactly, but in my eyes, it is absolutely not the case. Look here, as you can see this diagram, yes, I realize probably really small for you, but it basically just breaks down. Let me just explain what it is. You're going back from the 90s and then up until like after the financial crisis. So in the 90s, you have all these different banks, okay? You have, let me just show you an example of that. At the bottom, Wells Fargo, First Interstate Bancorp, Northwest Holding Company, South Trust, Wachovia, on and on and on. And as the years move on, it consolidates down to just a few names. Citigroup, JP Morgan Chase, Bank of America, and Wells Fargo. All of those other things got sucked up into the vacuum that are these multinational conglomerates, the biggest companies in the world, the most powerful institutions that, by the way, just so happen to be shareholders indirectly or directly of the Federal Reserve. Is that a little bit concerning to anybody else out there and maybe a little bit suspicious? Anyway, this shows us what's going on with all of the details as it relates to this SVB. Who benefits? I did the video just a couple days ago, or maybe it was yesterday. So many videos come in recently. That who stands to gain? Who actually benefited from it? One of those companies was JP Morgan. Oh, $40 billion of deposits left. Bring it on. We'll take it. That's what occurs. The consolidation occurs during these periods of time, and that's why the Federal Reserve needs to create a cycle, this cycle that actually crushes companies. And you think, oh, look, it's a hedge fund, it's being crushed. Oh, it's a bank, it's being crushed. Maybe that's great news, right? No, because it makes the big boys even more powerful. Look here, First Republic secures a new facility from JP Morgan. That was one thing, all interconnected, and I'll show you that in the next aspect. There are some companies that are benefiting. JP Morgan happens to be one of them. Now, this is just a couple things I want to move through real quick, just to show you that SVB draws support from more than 100 venture firms and investors. Hey, we want to support you, we want to get in. Hedge funds and banks offer to buy deposits trapped at Silicon Valley Bank. Dozens of companies have reported their exposure risk, which in its 4-decade history cultivated deep ties within the tech sector. This is just one more, just showing us the contagion, the risk factors that are at play. Even Mark Cuban said that he had exposure between $8 to $10 million in the bank. CostPlusDrugs.com, his company deals with SVB. I think we had about $3 million there. So I'm just showing you all these different people, all these different businesses that were somehow linked to this one company. It's pretty intense when you think about it. And of course, that extends over into cryptos as well. Circle's USDC stablecoin breaks peg with $3.3 billion stuck at Silicon Valley Bank. The expectation, of course, is that they're going to be bailed out from all this. And I think for a lot of people, they don't realize how powerful this is. It's so important to see it, really, truly, that we can enter into a moment in which things get so difficult so quickly. Think about it, 48 hours, over $40 billion went out the door. Some companies benefited from it. So I'm showing you here, all in all, what happened with the Federal Reserve and their new system and what exactly that system is going to do. That's important, so important, right? Because we're going to see other companies that are failing. Look at the third business that actually failed. Third largest bank. This is affecting cryptos. This is affecting, all types of different businesses, including guys like Mark Cuban and their company, which is, the health tech space. This is something that we need to be watching as interest rates stay high. The question is that it for Fed rate hikes? Well, I'll leave that up to you, and I'll see you tomorrow. Take care.